Good evening, everyone. This is Mike Gibbons, and through the wonders of the internet, I'm coming to you from Sydney, Australia, where it's rather cold, at least by Maui standards, which is why I'm all rugged up here. So today we're going to talk about how to trade options using the squeeze indicator on our cup with handle watch list. Now, this technique was brought to me about 6 months ago by Jim Easter, who was interested in using the cup with handle watch list to trade options. And Jim suggested an enhancement, which was to add the squeeze indicator, which, as you know, I did about 6 months ago. Now, Jim is going to be doing most of the presentation this morning, so I'm going to hand it over to him now, and he can introduce himself and describe how we're going to conduct the seminar.
Hello, everybody. This is Jim Easter. I'm coming to you from Boulder, Colorado. Can you hear me okay? If you can, just type in a question that says yes. If you can hear me and it's fine, type a 5. If you can't hear very well at all, type a 1. Yes, we got 1 yes. That's good. 5. Great. All right. So, as Mike said, he and I have been working through this trading methodology for, I guess, a little over 6 months now. And what we're going to do tonight is basically share with you a step-by-step process that we've developed that has proven pretty successful. And then if you have questions as we're going along, feel free to ask them. Now, we will have a Q&A at the end of the session, but if the question is kind of something that we can cover right in the moment, please type it in, and then we'll try to fit those in. If we don't get to it, we'll get to it at the end. So,
Jim, I can't see your screen. I don't know if anybody else can.
All right, we'll get there.
There we go.
That better?
Yep.
Okay, so you didn't miss anything. I was just talking before we go through the slides here. So if you've been in a trading webinar of any sort, you always get this risk alert. What we're going to show you tonight is not intended to be recommendations for trades. It's educational to show you how to use Mike's website and the vast amount of information he has on that site, and how I'm going to share with you what I've been doing, but I don't suggest that you should do exactly what I've been doing. I am going to show you some results, but past results, of course, don't really matter. Don't determine what's going to happen in the future, but hopefully you'll find some value in this, and you can develop your own trade plan from it. So, as you know, I think you all know Mike Gibbons. I think many of you are in a free trial with Mike. I was kind of in your place about maybe a year ago. I actually took one of his free trials. I was also beginning to trade options again after kind of a 7-year hiatus from it, and that's when I approached him about the thing we're going to show you tonight. I think Mike said in his email or his newsletter, I have a real job, and that's, you can have me to blame for why we're starting at this kind of odd hour. That's because I have a real job in the Mountain Standard Time, and I just got home. So what I do during the daytime is I'm an operational excellence manager at a pharmaceutical company in Boulder, Colorado, which is pharma speak for I help the other departments do make process improvements. So I'm very data driven, a lot of statistics. As you can imagine, in a pharmaceutical company, we do a lot of things with statistics and standard operating procedure, and I've kind of brought some of that mentality to this process. Not too much, but enough to keep it so that it's statistically valid. Prior to working at the pharmaceutical company, I was a trade systems developer at Janus Capital Group, which is here in Denver. Boulder's only about 30 miles from downtown Denver. Janus Capital Group is one of, it's like a a group of mutual funds and investment funds. And while I was there, I had to stop trading because I had inside information. And so for about 3 years, I stopped trading. And so in the last couple of years, I've gotten back into it. I also own a trading software company called Elephant Track Software. So I've tried to combine some of those things into this software company where we specialize in trying to identify where the big institutional traders are trading. But my real life are my grandkids. So that's really what my goal is as a trader, is to earn enough money so I can stop all that stuff above, at least working for someone else, so that I can spend time with these guys. And you might notice this little, I don't know if I can blow it up here, I've got one girl in this group. In that particular day, she wasn't very happy for some reason. So go figure. Anyway, here's what we're going to do tonight. We're going to review the cup with handle patterns. Mike's going to review that. Mike's also going to introduce, for some of you, or review with the rest of you, the new squeeze filter. I think it's really helped create a powerful scanning process for figuring out which stocks to take option trades on. I'm going to cover then what a call option is just briefly. This is not an options class. We are thinking about doing that later as a real class, based, depending on what kind of feedback we get from tonight and what the interest level is. But tonight I'm just going to cover briefly what a call option is. If you're an option trader, this will be a very simplistic approach. If you're not familiar with options, hopefully I can give you a little foundation so you can at least understand what we're doing and you can study up on it afterwards. Then I will cover specifically why we use options to trade the cup with handle move. I'll show you some examples of real trades, meaning I actually traded them in my real account, real results. I've also got some paper trades because obviously, being the statistician type guy I am, I didn't go with real money until I had some results to go on. We'll actually walk through how do you set the filters and alerts and actually get the information from Mike's vast amount of information and then allow you to do something in your trade platform. All right, then we'll end with Q&A. Now, if you have a question, go ahead and type it in, or if you have a comment, or if for some reason the audio is not working at some point, just use the question. We'll be monitoring those. So I'm going to turn it back to Mike. Mike, I'll just do the slides as you tell me to, if that's okay.
Yeah, okay, Jim. Now, you've got the slides, and I can't point to the slides. Because you've got control.
Let me change the presenter then. I'll change it to you.
Well, no, because I don't have the slides up on my screen.
All right. Well, we'll see how good I can follow you here.
To stick with what we have.
Okay.
I think most of the audience is probably familiar with the cup and handle pattern already. But I've put a couple of charts into the slide deck here. The first one is of TSU, and I did this a couple of days ago on the 11th of June. Often it's quite difficult for the novice to recognize a cup and handle pattern, although this one is pretty clear. But I've shown the cup on the left and the handle on the right. Now, there's a couple of very important channels that are showing on this chart. The first one is the outer channel, which is the Bollinger Band. That's in the very light blue or gray. And then the inner one is the Keltner channel. Now, the squeeze occurs when the Bollinger Band falls within the Keltner channel. And I've annotated that on the right-hand side. Jim, if you move your pointer over, there we go, where it says squeeze. What you'll see there is that the Bollinger Band, which is the outer band, has contracted to the point where it's inside the Keltner channel. Now what that means is that the volatility in the stock, and the stock price, has diminished. And as we'll explain later, when the volatility falls, then the price of the option falls. But as I said, we'll get into that later. Now, one of the things that I've added to the standard cup with handle chart is the squeeze indicator, which is the bottom chart. And this actually is a combination of momentum, which is the blue bars, the upper blue bars, that's when momentum is positive, and the red bars on the bottom are when momentum is negative. So this chart combines the momentum with the squeeze indicator, and the squeeze indicator is shown by those black rectangles along the center of the chart. So you'll see on the right hand side there, which is what we're interested in, that the squeeze occurs while the stock is within the handle. And if the stock goes on my watch list because it's in a cup with handle pattern, and it's also at the same time in a squeeze, then I set the squeeze flag on the watch list. And what we're interested in here is a breakout from a handle when we also have a squeeze. If the squeeze occurred earlier in the handle and there wasn't currently a squeeze on at the time of the breakout, then that's not a situation we're interested in for the purposes of this exercise. Now let's go to the next chart, Jim.
All right, I will get there as soon as I'm possible. There we go. Oop. Hun.
Nope. There we go. Now, as I was saying, sometimes the cup with handle pattern is difficult to recognize, and Hun is a good example of that. You'll see on the left-hand side where the price is 26.35. That is actually the left cup, because that was an intraday high, which is higher than any price while the stock was in the cup. And you'll see Jim is showing the cup there. The right-hand side, 26.07, that's the pivot. And the squeeze occurs, as you can see, starting way back at the beginning of May. The outer Bollinger Band fell within the Keltner channel, and along the bottom we're showing the squeeze, that the squeeze was on, and it was actually on before the handle formed, but it was still on during the handle, and it was on at the time of the breakout when the price jumped to 27.05. Now we're going to use this.
Sorry.
You skipped ahead. We're going to use this chart later because Jim is going to show you how he traded this particular cup and handle. So next slide, Jim. So to summarize, the cup and handle watch list gets a squeeze flag if the Bollinger Band is within the Keltner channel. The price must have positive momentum. In other words, on the chart that we just, or the two charts we just looked at, there should be blue bars above the center line. There we go, Jim's just showing them now. So that shows positive momentum. And there must also be positive momentum slope. That means that there is actually an acceleration in price. If that acceleration isn't there, then we don't flag what the stock as being in a particular squeeze. Now, the reason we look for positive momentum is that the back testing that I've done shows that we're more likely to get a good result if the momentum slope is positive. It's not just sufficient for the price momentum to be positive. Okay, Jim, back to you.
All right. So based on Mike's adding the squeeze filter, and we added one other thing, or he added one other thing also, and that is that the stock is optionable. Let's see if I can get my highlighter here to work. So when you go to the Breakout Watch Mine for Candidates and go to the Cup and Handle watch list, you should see that you have an option, and in addition to what's been there all along, we've got these two new things, and Mike's also added two more things here. We're not going to talk as much about that tonight. It's kind of an advanced topic. I want to make sure that you understand how I'm taking this Cup and Handle watch list and what I'm doing with it. So this is kind of your centerpiece. This is the thing you're going to identify which stocks are at least candidates for an option trade, and then we'll walk through what the actual process is for going from there. Okay, so if you've been on Mike's subscriber to Mike's website, then you're familiar with that. If you're not familiar with it, you just go to Mine for Candidates and go to long. I'll show, if we have time, I'll show you how to get there. If you're brand new to it, you probably may not be familiar with that. But all right, so one of the things I want to do, though, is I don't want to see everything that's in a Cup and Handle. So the first step is to create a filter setting. And let me see if we've got any questions here. Okay. The filter setting, you go to the filter setting that's above the list. You click on that, and you're going to get a pop-up thing that looks like this. I want to make the filters active on this watch list. I want to make sure you can focus on here. We're going to send you, if you want these slides, we'll send them to you so you don't have to take all copious notes. I tried to make the slides so that you could come back and kind of review it. So if hopefully that'll work for everybody. I want to save the filters so they don't have to do this every day. And then this one's a real nice one. Filters would be applied to email alerts. And I'll show you how you can also get it as a text message to your smartphone. I work, as we've mentioned several times, I work during the day, so I can't sit at my desktop trading PC and watch this. So what I've done is whenever one of these triggers, which we'll show you here in a minute, you actually get I get a text message. And I do have enough flexibility where I can kind of find a few moments after that alert and go look at it and put the trade on. I've also made it where I auto trade these, meaning I've set up the breakout price beforehand the night before. I'll walk through that here in a minute. So there's a lot of different ways you can take these alerts. So if you notice some of these other settings, basically the only other filter I want is I want the breakout volume to be a certain threshold. I want it to be optionable. Let's see if I can get my highlighter here. Problem with the highlighters, when I use it, it does allow me to ever click on anything again until I erase it. So I want to set the optionable to yes, because I'm only interested in stocks that have options. I want the squeeze based on that criteria that Mike just went through. And I also just, because the other thing that I've discovered is that if you don't set a volume threshold here, you're going to get a bunch of little stocks that, while they're technically optionable, they don't have enough volume to actually get in and get out safely. So this is somewhat an arbitrary number. You might even want it to be higher. But this is where you're going to have to kind of play with it and make it so that it's based on your trade plan. So we'll use this email alert later when we get the text messages, but these are settings you need to be based on your trade plan. For instance, you might say, you know what, I just want to play the stock. I don't even want to play options. Well, then you can take this and make it optional equal to NA or nothing, I guess. Can't remember what it is, but then you'd get everything. Well, so that might be what you want.
Jim, I'm just going to break in here for a second. Leave that filter slide up, would you?
Yep.
The filter on there that Jim hasn't mentioned is the breakout price. Now, you may want to filter on breakout price because that will determine also what the price of the option will be to some degree. There's some kind of relationship, although
Right
it's
here.
not always determinant as to exactly what the relationship is. But the relationship between breakout price and option price. So if you don't want to trade costly or expensive options, then you may want to set that a filter on breakout
Very
price.
good. Yeah.
Now,
Excellent.
I also see, Jim, that we've had a question,
Okay.
which is faster, text messages or email? And really, the answer, I think, is that as far as the website is concerned, they're both sent at the same time. So one is not necessarily faster than the other from the point of view of the server. But from the point of view of the receiver, of course, there may be a difference depending upon how quickly you pick up your emails,
Yeah.
or how quickly you
That's
pick
what
up
I've
your
noticed
messages.
is that I get the text message a little sooner. I mean, it's not enough to. I also have my email being checked very almost real time. So that, as Mike's saying, affects that. But they're sent out at the same time. I get them about the same time if I'm checking both of them in real time. So hope that addresses that. It's pretty fast. I'll talk a little bit about that in a moment. Are we ready to move on?
Yep.
All right.
Go ahead.
So with those filter settings I just showed you, this is again the typical. You'll notice that I'm only showing optionable stocks here. I'll try to get this highlighter. Optionable and squeeze. And these, I'm not sure if I had breakout volume set on when I did this. If you only wanted to see stocks with 1 million or more breakout volume, then you wouldn't have gotten everything below this number right here. So anyway, enough on that, I think. Now, to set the alerts, you go to Alert Preferences, and Mike can remind us here in a minute how we get there. But here, once you're there, you basically, in my current trade plan, I don't trade any shorts, so I turned off the short position watch list. I do want to send alerts on the long position watch list. It says here including base watch breakouts, but I'm actually only going to get cup and handle. I'll show you how I do that here in a minute. I don't want to just be limited to stocks on New York Stock Exchange and NASDAQ, although that's probably the ones I most often trade, so I may actually play with that down the road. Now, here's where I restrict. Under restrict long position alerts to filters or personal watch list. The only setting I have, the only watch list that I have alerts set on is cup with handle. So I check yes here so that it doesn't send me all the other alerts from all the other long positions. If you're familiar with Mike's service, there's multiple long watch list, and I actually plan on developing some additional trades off of some of the other watch lists. But for right now, I'm just doing cup with handle because it's by far the strongest one I have found. You can also have a personal watch list which says, hey, I want to filter it even more. I only want certain stocks. Maybe you have a favorite 100 stocks and you only want to get those. I don't have that currently, so I don't have these checked, but you can filter this. So this is a really nice combination, because if you have a set of favorite stocks and you want to be alerted when those stocks are in a squeeze, for example, and on a cup with handle in this example, it's a great way to get that to filter right down to where you want. And then you hit change preferences and it saves those. Lastly, in terms of configuration, again, you're going to get these slides, so don't worry about. You can go back in your leisure and figure this out. But if you go under Support, Account Management, and Update Account, you get this window, and you can see my primary email address. But look at let me get my pointer here. My secondary in email is my text messaging. Now, this is AT&T, so you put your phone number in there at text or txt.att. I don't know what the rest of that says, probably com, I'm not sure. But go to, if you're on Verizon, go to Verizon. They'll tell you, they'll have a support thing that tells you how to do that. It's some form that's very similar to this, so it's very simple. If you're, I think they all have them as far as I know, especially T-Mobile, Verizon, AT&T. What's the other one? Sprint. Do they have one anymore? I don't even know. But so that's how I get text messages. This other stuff is just for setting what happens when you log in. So essentially you want to set this one. I also do get an email just in case my iPhone is, in my case I have an iPhone, in case it's not working. So just to be sure. This is what the alert, this is what the actual text message looks like. I'm actually going to show you the one on, we're going to show you the examples here in a minute. And I'll show you a couple of things on here. Give me 1 second while I get my pointer working. All right, when I get, so this is coming on my phone, obviously. I look, first of all, to make sure it's the list I'm interested in, which is the cup and handle. I then going to look at the breakout price. I'm going to look at the breakout volume, and I want to make sure the squeeze is on. However, that's a lot to look at in real time. So what would be nice, and what I have found that works really well, since these stocks come on the watch list several days, up and 1 to several days before they actually break out, I already knew that this stock, EOG, was getting close to a breakout. And I also knew that it was in a squeeze because it's going to be in the handle. Or I should say, if it's in a squeeze during the handle, it will say that. And so I can set these up on my trading platform. I use TOS, Thinkorswim. I can actually set these up. So because I know the breakout price, that's the price we're waiting for the stock to hit before we enter it. This breakout volume, I'm actually not using to decide if I'm trading it. I'll show you how I do that in a minute on a different set of volume. And of course, I want to make sure it's the cup and handle. And so if you happen to be on several of his watch lists and getting alerts, you just need to check these. Does that make sense? Everybody follow me on that? This is where you guys type in yes or no. I'm trying to see if anybody can hear me still. Hopefully everybody didn't fall asleep. I haven't seen anybody type anything in yet. Mike, check me on that. Make sure we can still hear. All right.
Well, I can hear you, Jim.
All right. Well, you know, hey, well, we're entertaining each other anyway. You guys out there? Everybody all right? I don't see any questions, so I'm a little concerned.
Well, we're getting a lot of yeses.
Oh, okay. I'm not seeing that. Maybe I'm just not seeing them. All right, good. Sorry. All right, so the basic process that this cup and handle trade is going to go through is you're going to set your criteria in your filter, set alerts. That's what we just did. I'm going to review Mike's watch list nightly, and I'm going to pre-qualify the option trades by going through this bottom set of steps. I'm going to review the option volume first, then set the alerts here is not the alerts in Mike's website, but these are the alerts in my trading platform. I eventually learned how to set up a conditional trade so I didn't even have to get an alert. It would automatically enter out. We'll talk a little bit about that. We're not going to show you a bunch of mechanical ways of entering the trades on platform, since not everyone has the same platform, but I'll talk about what I do. I'll show you how to select the specific options, and then we're basically going to enter one way or the other when the stock price breaks above breakout price. All right, so that's what we're doing here. Oops. So if you remember the cup and handle with squeeze, the Hun example that Mike went through earlier, let's trace what happened to this thing. Now, this happened on May 19th, I believe, so we're talking about back here Let me get my spotlight here. We're talking about, we don't know all this is happening. We're right here in a moment in time. I get the watch list the night before, and it's essentially right here. So hopefully that makes sense. And so then we're going to trade options. But before I talk about options, I want to make sure everybody knows what we mean by an option. So here's an everyday example. Let's imagine that you discover a house that you'd love to purchase, but for whatever reason you're not going to have the cash to buy it for another 3 months. You talk to the owner and negotiate a deal that gives you an option to buy the house in 3 months for a price of $200,000. The owner agrees, but for this right, he wants you to pay him $3,000, which you decide, you know what, it's worth it. So basically you pay him $3,000, and what you've just bought is the right to buy. It's another way to say it is you have a call option. Think of it this way. You can call the homeowner anytime and say, okay, I'm ready to buy. I don't know that that's technically why it's called a call, but that's how I remember it. This costs you $3,000 to buy this right. It expires in 3 months, and any time within the next 3 months you can buy the house for $200,000. And it's cost you $3,000. Now, because he sold you this option, he can't go sell the house otherwise, unless he some reason buys you out of your option, but that's off topic. But so let's imagine that 2 days later it's discovered the house is actually the birthplace of Elvis. So as a result, the market value of the house skyrockets to $1 million. Now, because you now own the right to buy this house and the owner sold you that option, he's obligated to sell you the house for $200,000 because that's what you bought the right to do. In the end, you stand to make a profit of $797. That's the $1 million the house is worth, minus the $200 you had to pay for it, and then the $3,000 you paid for the option. So when you buy this house, you've already spent the $3,000. That's gone to the owner. Then you write him a check or her a check for $200,000, and now you own a $1 million house. So during this time, you could theoretically sell your option to someone else for the $800,000 that it's worth. All right, that's great. Or this could happen. 2 days later, you discover that the house is actually built upon an old coal mine and it's about to fall into the sinkhole that appeared in the backyard yesterday. The house is no longer worth $200,000. In fact, it's almost worthless. Your total cost, your total risk is still just the $3,000 because that doesn't obligate you to buy the house. It just gives you the right to buy the house. So let's assume that, remember, this was a 3-month option, and this only happened 2 days later. So we still have almost 3 months before this thing expires. For whatever reason, the market says, you know what, something else could happen. We're not going to take that option down to zero. It's worth $300 because there is still time left in the option. So since you could sell it for $300 that day, your total loss would have been just $2,700. So that's the $3,000 minus the $300. Now at this point you have two alternatives. You can sell the option for the $300, or you can simply not exercise that option, and when you do that, it allows you to let it expire worthless. You don't have to do anything because it's essentially worthless. Now, 4 days later, at the bottom of the sinkhole, workers discover oil and natural gas reserves. Certainly a house and land, really. The house is still worthless, but the land now is worth $5 million. So now your option jumps in value to $5 million. And if you decided just to hold on to the option, you'll probably be very glad because you didn't sell it for $300. So the point here is that the option's going up and down in value based on two kind of drivers. One is, what's the value of the underlying thing that you have an option to buy, and then what's the value of the time that's left in the option. Now it's a little more complicated than that. We're not going to get into the Greeks. Again, we're thinking that we might offer a true class on options and on this trading methodology, so we would cover it in there. But these are really the basics, and hopefully that makes sense to everybody. Mike, I'm not able to see the questions, so if there are any, let me know.
Okay, well, we did have a question
Okay.
asking about the squeeze play watch list and whether you had made any trades off that, and I think the answer to that is no. You've been focusing on the cup with handle
Correct.
because that's what we
Right.
started off with.
Right.
Let me see what else we have here. Is the breakout volume measure abnormal? Now, for the breakout from the squeeze, what I have found in my back testing is that the breakout volume, which is normally 1.5 times the average daily volume, is not significant. So in other words, you can get a price breakout without there being the equivalent volume level that we normally look for. So you can trade the option if it's a breakout from a cup with handle with a squeeze independently of the volume. So I hope that's clear. If it's not, I'll make it clear in one of my newsletter articles.
Right. So to kind of tie this together, I am trading these options that pass the criteria we just talked about and what I'm about to show you on option volume. I'm trading them as soon as the alert comes out, which is during the day. At that point in the alert, we don't know what the breakout volume for that day is going to be. Now, one way to trade this would be to wait and trade only if it was a fully qualified breakout, as Mike calls it. I have chosen not to do that. The reason I chose not to do that is that I found that I didn't need to from a profitability standpoint. That in fact, one risk you run of waiting is, of course, the option is going to be going up in price during the day. So again, that's a refinement that we can talk about at another time. But just to be clear what I'm doing, I'm getting these alerts. I have set them up the night before in my trading platform, so I don't have to go do all that analysis. And basically, I'm making a go no-go decision either the night before by saying, "Hey, when it breaks out, I'm going to go in," or I'm waiting real time to get the alert on a text message. At which time I've got Thinkorswim on my iPhone, and I literally step out of my meeting if I'm in one and go make that trade because I've already figured out I want to trade that stock. So just to be clear.
And it's probably worthwhile me adding that the alert is sent based on price only. Volume is not a consideration. When I first started with Breakout Watch, I used to only send the alerts if the projected daily volume was 1.5 times the average volume. But I found that that projection was extremely unreliable. So I dropped that requirement. So the alert is issued only when the price reaches the breakout price, and it's independent of the volume. Now we have another question, Jim, which was, do you enter trades for squeezes that fire without a cup and handle breakout? And I think the answer to that is no, because we're only looking for breakouts from a cup with handle when there is a squeeze.
Yes. What we're showing you tonight, that it has to be a cup and handle. It has to have a squeeze in the handle. It has to be reaching and actually breaking through the breakout price. And the one other thing I haven't covered yet that I'll cover in just a minute is the underlying option has to have enough volume so that I can get in and out of the option trade without a bunch of delay. I'll show you how I do that in a minute. Now, there are other ways you could play a squeeze play, but that's something we'd cover if we do an options class. There are other ways to play the other list that Mike has, but what I'm showing you tonight is what I just said, and I'll show you the data from that. And frankly, it's a work in progress. I think we're going to look at the squeeze. I think the squeeze watch list has a lot of promise. For one thing, you get a lot more stocks on it, so you can be a lot more judicious in which stocks you take. So let me finish this example just so we can get some terminology, and we've got about 20 minutes left. I want to make sure I get through some of the actual trade examples. So
Just
in
quickly, Jim, one question, another question here is, do you religiously stick to the breakout price?
Yes.
Yeah.
I did a test. I don't have the data, but I can try to find it for if we do this again or put it in a newsletter. I actually tried a hypothesis testing that, like we do in the pharmaceutical. We did a test that said if you simply wait for, if you trade the stocks that are on the watch list and you try to anticipate the breakout so you're getting in earlier, is it better? At least with the test data that I had, no, it's not better. You have more losers. The winners are pretty much the same anyway. So anyway, for what it's worth, I didn't find it. Doesn't mean we can't go back and refine that a little bit. But right now, I wait for the breakout price to be traded, essentially. All right. Let's go on here so we get to the real meat of this. So just some terminology. The $3,000 you paid for that right to buy that house is the option premium. The expiration or expiry is the 3-month. The strike price is the $200,000. That's the price you can buy the underlying house in this case, or stock in the real life example. And if you come down here at the bottom, the fact that it has $800,000 value in that first scenario, that's the intrinsic value. That's the difference between the market value of the house and the underlying option strike price. So we'll be using those terminologies. So for instance, in a actual stock that's selling for $15 that magically goes up in a straight line like this, the lighter colored green bars is the intrinsic value. That's simply the difference between the stock price and the strike price, which in this case is a $15. But if you notice this, the upper part of this bar is fluctuating. It's always a little bit more than the intrinsic value, but it's going up and down, up and down. If you remember in our example, the option value went from $3,000 to $300, and then back up to an enormous value when the house went up. So what is all that about? What's causing that? The actual price, the option is moving. What causes it to fluctuate? And this is a very fast review. First of all, what's working against us if we own the option is that time is eroding the value, because we're just losing value every day that we own a stock, own an option, to time. Offsetting that could be something else going on, which is if the market determines that the chance that the stock's going to go higher or lower is changing, then this can affect this price as well. This is called implied volatility. The best definition I've run across of implied volatility is that it's a made-up number that reflects what the market makers are anticipating this stock's going to do. And when I say it's made up, I don't mean it's completely baseless, but there's not like it's basically based on the probability they're attaching to that stock going up or down depending on which way they're playing it. So what it's really based on is the expected stock price changes. But it's also based on what's the volatility of the stock doing right now versus historically. Mike alluded to that earlier. So if you remember what we said about this play, we've got two kinds of energies going on. One, the cup and handle pattern itself is a precursor to the likelihood that the stock's going to break out and go higher, which obviously affects how much that option is worth. The squeeze itself, if you remember, essentially what the squeeze is it's black during the time it's low volatility, and when it breaks out, that volatility increases from that breakout. So in other words, when the squeeze is over, we will have higher volatility. So the reason we use cup and handle with the squeeze filter is that the price of stock should go up. No guarantee, of course, but it should go up, and the implied volatility should go up of the stock and of the option. Now there's some more complications in that, but think of implied volatility as the risk to the seller of the option that they will have to pay off. It's sort of like if you were an insurance company, your insurance premiums would go up if you were expecting more hurricanes, because the chances that you're going to have to pay off goes up with hurricanes. So essentially it's that we'll not get too much, I don't want to get bogged down in that. We can actually look at an example here. This is a cool little thing. Mike, tell me if this comes across because I can't tell.
Yeah, I can see it.
All right.
Yep.
So options are really, there's a theoretical value calculated by, one of the popular ones is the Black-Scholes option. There's some other ones. These guys that wrote this actually got a
Nobel Prize.
Yeah, Nobel Prize. Thank you. So essentially, it's driven by these variables: strike price, the stock price, the time in days, that is until expiration, this volatility in the market. Now remember, this is kind of made up. I mean, it's a reflection of an estimate, so you don't think of it as gravity. It can change. It can change without notice. And then technically there's a risk-free interest rate. I just put 3 in there to get a placeholder. So if we had a $25 option strike price, when the stock was $25.85, that was 17 days for expiration, and the market maker said, hey, it's 35% volatility, theoretically that call should be worth $1.28. All right? If the next day, because it was a breakout, the stock went to $27.85, nothing else changed, that option should go to $2.95. So the stock price really drives that. Now stock price drives that. If you held this, nothing else changed now and we went 2 days later, you will notice that the price of the option went down, went from $2.95 to $2.93. So if in the meantime the volatility went up because now the market makers are going, wow, this stock could really run away from us. Let's say it went to 60.
Well, the price has gone up. The price has gone up, so therefore the volatility goes up.
Notice that all I changed was the volatility from 30, whatever it was, and now the option went up to 327. 328 thereabouts. Now this is theoretical. It's not the market. The market is using this to approximate the price, but the real market is set by the buyers and sellers. So it'll tend to fluctuate around this, assuming these are the right factors. All right, let's go back to our thing. So here's a simple 4-step process for trading off of this watch list. We find the cup with handle and squeeze stocks that are near their breakout price. Well, that's what makes them go on the watch list. Within that, we're going to take and look at each of those that are on that watch list and find those that have enough open interest and small bid and ask spread in the option. I'll show you how to do that on TOS. Your trading platform should have all that. You're either going to place a standing order the night before when the price at a trigger price of above the breakout price, and I mean like 1 penny above it, or you're going to do that in real live mode as you get these alerts. And now I am looking to buy, this is what I have done, buy the call options closest to the breakout price but still in the money. And when I talk about in the money, let's imagine that we had a stock that's $15.50 at any moment in time. You went to your trading platform and you saw all these strike prices from $10 all the way up to $20. When the stock is at $15.50, anything below $15 would be in the money. You can see here. Technically, at the money would be approximately around here. That's what I'm calling at the money. And then out of the money would be anything above that. There are many, many different trading strategies and options. The one I'm doing that I'm going to show you the results is I would buy the at the money. I'm looking for the strike price closest to the stock. Let's assume this was the breakout price, $15.50 on Mike's watch list. Well, 16 is still above it, and 14's not the closest. So the closest one is $15. So I'm going to look to buy the $15 strike price for that stock. It's in the money, technically, because it's 50 cents below. Now, the other thing I do is I want to find the stocks that have enough open interest in the ATM call option. What I mean by that, this is TOS. I'm looking at Hun. This is that stock we're looking at, $25. So I'm going to be looking at the stocks at $25.85. I'm looking at the $25 strike. This open interest, I'm looking for something around 500. I have not tested that in a scientific way. It's just what I've noticed, that the best of the best seem to have at least 500. It's not a hard and fast rule, but it's where I start. The other thing I'm looking for is there not too much delta between the bid and ask. So this stock option is trading for 115 by 125. So I should be able, if it's got good volume throughout the day, I should be able to buy somewhere in between 115 and 125. This is real data on May 19th. I know I'm going fast here, but I don't want to get bogged down in how you do this on your trade platform. If there's a lot of interest and most people are on TOS, let Mike know. We can actually do a follow-up with a TOS, more TOS specifically. I don't know what everybody's using though, so I didn't want to get too locked in. So what I did on May 19th is I bought a $25 call, a June option, because I'm in May at this point. So I wanted to give it enough time. And this is the actual price I paid, $1.20 right here. Now, what I did for tonight...
Sorry, Jim, could you point that out again where
right here?
You're showing the actual price? Okay, it doesn't come across very clearly.
All right, let me see. Let me use something else here. How about an arrow?
Yeah, that's better.
There. So that I actually got $1.20. And so what I did is I do track these, although because I've got a job, I can't track them in real time. But these prices here are real prices, but they're the end of the day midpoint between bid and ask. So theoretically, it's rare that the options are going to necessarily end on their high or low. So you can be assured that sometime during the day it traded, well, this was a closing price each day. So on the 20th, my option went from $1.20 down to 105. So it actually lost a little value. The next day it closed at $1.32. Then you can see that it kind of meandered around. Then it took a big jump, and you can see these prices. Again, I'll send you these slides so you don't have to try to copy this down, but these are the real market prices. Now I wish that I could have told you that I held it all the way out to here, or maybe even better there, but I did not. I didn't know this was going to happen. So I'm still determining my exit strategies really, and I think I got out, I'd have to look, but I think I got out about right here. What I have found is that you need to hold them 3 to 14 days, and actually the latest data I have is if you've got a really strong cup and handle and you did it by the book here and you actually had a squeeze and you got a good strong volume on the breakout, it actually does better even later. So if you notice, this thing went from $2 back down to $1.60, kind of meandered around, then it really jumped up. I don't know what day that is. It's the 6th. I just don't know how many days that is here, but somewhere between 10 and 14 days it does tend to come up. Now, of course, you're going to have to buy an option that's far enough out that you have 14 days, so that's the other part of this.
Now, the interesting thing to me here is that if you'd bought the underlying stock at the breakout price of $26.07 and you sold it at its peak at $28.87, then your gain is a little under $3 or 11%. Now you compare that with the gain on the option where it's gone from $1.20 up to where Jim sold it at $1.60. That was a 30% gain. So you're profiting there from the extra leverage that the option provides you. And if you'd held it even longer, as you can see from the prices there, it would have almost, well, certainly more than doubled in price.
Right. I actually show that a little bit later here. Let me, I'll skip ahead here
Okay.
pretty fast. This is the actual alert that I got. So I got this at 8:52 a.m. I'm in Boulder, so that's Mountain Standard Time. You'll see that the breakout price was at 25.82 Mike was just talking about. And so this is what triggered me to actually go in and trade it live. I didn't have this set up the night before for some reason. I think I've had a lot of technology issues trying to do this from work, so I didn't feel comfortable setting it up and not being able to go in and monitor it. So I think this was back when I was still doing it on my, where I finally figured out that the best place to do it was on my iPhone. I knew HUN was a qualified trade. I didn't do all that analysis in real time. I did that the night before. All right, so I'm looking for HUN. I know that it's on my qualified list from the night before, so I did all that analysis about the open interest. What is the strike price I want? What's the breakout price I'm looking for? Of course, that's the breakout price on this alert. It's a cup with handle. It's in a squeeze play. And the breakout price. I technically know that the breakout volume is whatever it is. I'm really more concerned about the option volume than the breakout volume because I don't know what the volume is going to be for that day. So again, I'm buying the at the money call closest to the breakout price but still in the money. That's the 25 because the breakout price was, what was it? Go back up.
2607. Yeah. Okay. Yeah.
25.82 here. So this is actually after it broke out, if you look at it. So I probably pulled this up and took a snapshot of it or something. Anyway, you see the bid and ask is $1.25. The open interest is 1,000. So this is to me, this is like right in the wheelhouse. It's the right price for me. This is what that option actually did in price. So you can see it went up really nicely at the beginning, then it kind of levels off a little bit, still going upward. Then it really shoots up. This is 14-day look. Here's what I did this for you guys in case somebody can't do the math quickly on top of their head. If you traded one contract, you got in for 120 because one contract, if you remember in options, I didn't cover this, but if you're familiar, is 100. It's equivalent to 100 contracts of the stock. So I paid $1.20 times 100. And then if I'd have kept it the whole time, I would have gotten out really somewhere between 365 and 355. And as Mike mentioned, the stock at the breakout was 25.85. The stock on this last day, 15, I just took one extra day snapshot for you, 28.83. So it went up. That's not right. That's not 112%. I don't know what that is, but this the option almost tripled. 360 would have been tripled. So it is that leverage. Let me move this guy out of the way. If you this right here, the capital, this is how much you'd have to have in your account. Let's say you did 10 contracts, which would take you $1,200, because your only risk is the cost of the original, in this case, 10 contracts. So that'd be $1,200. And then you had to bear a little heat here. It went down to $1,050, which is about $150 in heat. This is not abnormal. It might be a little better than the average. It does tend to come back after it breaks out, but I have found maybe I'm just too impatient, but I'd rather just get in and ride it, at least as far as I can stand it, which is somewhere around 50%. I start really caring what the thing's doing. I'll show you what the track record is for across a lot of so now what I'm showing you here, and I know we're just about out of time here. I don't mind going over a little bit if you do, Mike. Don't mind.
Well, I certainly don't mind.
All
Let's
right.
just keep going, and people can leave if they have to,
Okay.
or they can stick around.
So what I did last November is Mike and I started doing this, and I was paper trading, and The nice thing about paper trading options, at least these kind, is you're not doing, I mean, while these things are moving, they're not moving, you know, out of control usually. So being able to paper trade is pretty accurate to what you could get in and out of these stocks, these options for. Except for the fact that when you're trading live money, you now have emotion, and so that stops you in your tracks, or it makes you get anxious and all sorts of things. So you see here the blue is the track record. Back when I was doing paper trading, I only tracked what happened the first 7 days. So you can see that a lot of the average, these are averages, not the best. These are the average. We had an average of, on day 6, 100% gain in the option price. And then it fell off after day 7. The live trades, and in the paper trades, 78% of the fully qualified, now by fully qualified I mean it's a cup and handle, it's on the watch list, cup and handle watch list. Mike has issued an alert on it that has broken out, and it's in a squeeze. So it's all those filters we covered earlier. And I'm only trading it if it has sufficient open interest so I can get in and out. So I would say, depending on how you set your filter on the breakout volume required, probably stocks that have a breakout volume of 1 million or more, almost all of them, maybe 75% of them, turn out to have enough option volume. So you'll have to kind of tweak that. But that's a pretty high percentage, 78%. What I mean is 78% of them either break even or don't or win. So that's a pretty good number. Now live trading, it's a really small sample size, guys. Because I've been working and not being able to. My biggest issue has been trying to figure out how to manage and enter the trades from work. So I haven't done very many. It's probably about 7 trades in the last month and a half. But in reality, you can see how they've gone down initially because there's just only 7 trades. So as we gather more and more live trades, I'll add to this and we can share it in the newsletter if that's appropriate. So this caveat here as a stats person is like, well, I don't know if this is that reliable, but it is moving up. Here's what's interesting is that it's really moving up in the later 7 days. I'm really interested in getting some more data and see if that continues or if it's an anomaly in the market that we're in. So this says 5 trades. I think I've traded 2 more since I put this slide together. So the paper trades were only about 14 trades. I am planning on going back and getting some more paper trade data. Now that I know how to do it in TOS, it should be doable. So I'm very data driven. Now I said there was a simple 4-step process. That's not exactly right. It's 5 steps. And the last step should be determine an exit strategy beforehand. Don't wait until you're in a trade to figure out, well, how am I going to manage this trade? I'm telling you this because I didn't do this initially, and I've been getting out. The irony is that what's happening is I'm leaving a lot of money on the table, which I guess that's a nice problem to have, but I'm just being transparent here. If you don't determine your stop strategy ahead of time, this little girl is going to cry. Because you're crying, because you cannot. I don't recommend figuring that out live. Now, when I say determine your stop strategy, that might be a dynamic stop location. Like you might say, hey, I'm gonna base it on the low of the bar in the stock or something like that. So it doesn't necessarily mean you've said I'm going to get out when the thing hits X. I'll share with you what I've done. It's still a work in progress. You can use chart patterns and indicators like Ichimoku clouds are really good. That's something I'm looking into. You can use standard candlestick patterns, or if you have other indicators you like. I'm not a big indicator guy other than the cloud at this point, other than the squeeze, which is helping us get into this thing. So, or you can set up a % gain, like, hey, I'm going to get out if when the option hits 50% gain, I'm just going to count it as good and go on. That's how I was originally doing. That's how I'm getting out early. It's really difficult without data to have 100% gain in an option and not get out. But that's why I would urge you to collect your own data and determine, for yourself what's good. You can also set a percent loss or dollar loss, X upon reaching it. That's also important because these are not 100% winners. What ideal would be is to cut your losers quickly, but you don't want to set it at break even because a number of these, a large percentage, go down the first 1 to 3 days, just depending on, what the buying and selling going on under the underlying stock. But they don't typically go down very much, and I'll try to gather some more data on that as we go along. So if it does seem like a small pullback on day 1 to 3. Now here's I'm not actually looking at the stock as much as I'm looking at the option price. So I'm actually not as conversant about what the underlying stock is doing. That's something I want to get better at. It's just I don't have that much attention span when I'm having to go out of a meeting and check it, So hopefully if you're able to sit at your computer, you can help us gather some of this data. That'd be a cool thing to do together. So as I say, don't freak out too soon because these things are not going to go straight up. So again, the basic process, I've added one more box, determine your exit strategy. So Mike, you want me to, are there any other questions? Again, I'm not seeing them come across. So
yeah, there's quite a few that have accumulated. So let's go through them.
All right, good.
So can you sell puts instead of buy calls to benefit from volatility increases?
Yes. Yes, you can. And I actually do put credit spreads as part of my option strategy. I have not done them on the cup with handle yet, just frankly because I haven't mastered this one yet. And a selling, and I don't want to get too complicated, this is something we'll cover in an options class, but yeah, selling a put credit spread, for example, which is different than selling a naked put because you're controlling your risk, is a play on a stock, is an appropriate play, or could be, if you expect the stock to go up. And as a result, since the cup and handle is a bullish pattern, it could work. It could work nice. And so stay tuned for that. If you happen to be doing that on these patterns, please share your results with us because that could be just as viable. And depending on your what your trade plan is, it could be a much more stable way to do this. So, yeah, that's a possibility.
Now the next question is, do you choose RS over probability in your choice of trade? I think I'm probably best equipped to answer that. Gary, who's asked the question, and I have done quite a bit of work in the past on RS, and followers of the site and the newsletter will know that I have always recommended a high RS as being part of the decision making. In the case of the probability of a breakout from a squeeze, the RS is one of the contributors of the formula, but it's not the only contributor to the formula. So I think that it would be definitely preferable to prefer probability in making the choice of if you have a choice of stocks to trade, rather than the RS. Let's look at the next question. TOS. What is TOS? TOS is Think or Swim. It's a trading platform which you can use to trade options. What is good volume on an option? So you're best equipped to that. I think best equipped to answer that.
I'll give a smart aleck answer first. Good volume is volume that's enough. And what I'm really looking for is enough open interest, which, if you're looking at this at the end of the day, your trading platform may only show you open interest. When I say good volume, I just mean enough physical volume. I don't mean there's bad volume, if that's what you may have thought I meant. I just want enough liquidity in the option that I'm not waiting for 3 days to get out of it when I need to get out. So hopefully that makes sense. Now, open interest is basically the number of contracts open at the, well, when I'm looking at it after the market to be end of the day. During the day, you'll get volume also. Let's see if I can go back to that slide. So during the day, you'll get volume. Wait for the slides to catch up here. This is just like stock volume. This is amount of volume. So at whatever moment in the day I took this picture, there was 209 contracts traded for this 25 call. Prior to today, there's 1,000. And again, I'm arbitrarily, because I don't know any better, haven't got any scientific data yet, but that'll be something we'll do down the road, it seems to me around 500 I'm talking about open interest. And also, just parenthetically, I like it that not just the one option has got volume. You see how the options all around this are trading. So that's a good sign that the market's, there's enough interest in this that I can get in and out. So
the follow-up question is, what is a good bid-ask spread?
So I answer very pragmatically, and that is, if you're willing to buy it at the ask price and sell it at the bid price and not feel like you got cheated, you're probably okay. Now I'm talking about if it goes up, right? So this is a dime. And if you remember, this particular one went up. Let me, so remember that dime. Where's my little table of values here? So a dime doesn't much matter to me if it went from $1.20 to $2 or even $1.60. I'm not, a dime might worry me in $1.60, but somewhere I'm trading under $4. I would say somewhere between, 5 and 20 cents. I don't really know yet. I haven't got that. Given that we're going up, some cases 100%, I'm more worried about, actually this is a good segue, I have missed out on trades because I tried to get, I tried to cheat that dime and say, I'm going to get it for a nickel. But I'm going to get it for a nickel better than the dime would have forced me to do. And there's been times, because I can't check it every moment of the day, that at the end of the day I realized my order never got filled. So that was 5 cents I was trying to make. Meanwhile, the thing's gone up, 30 or 40 cents that day. I kind of had a standing rule that I don't chase it, so I don't go back in and do it unless it came back on the watch list later. And so the best trades are the ones I've missed for a nickel or even a dime. So that's just me. If I could watch this in real time, I probably could get a little better at it than that. So
now here's another question, Jim. Do you use a stop at all in the trading?
Yeah, I've been, yes, I use a trailing stop. What I've started doing now is using a trailing stop. I don't have any scientific way of setting it yet. So basically what I'm doing is calculating, well, if this thing went down, if this thing, not 30%, but if it went down 30 cents, that's the percentage I notice these things going down. Then I try to set my trailing stop so it won't get me out during that pullback. And I don't have this mathematically calculated. I'm still working on that. So trailing stop is one way to do it. You can also calculate the price the option would be at that would cause you to lose the most money you can afford to lose. And you can do it that way. What I'm doing is I'm typically putting a trailing stop in now on the option.
Another question is, can you share another trade? I'm not sure about that. Given that we had set up
I don't have it set up tonight, but I'll be glad to come back sometime and show, any of the trades I've done. I can do some paper, show some paper. I just don't have it set up, and it's a little cumbersome to try to pull up. So I don't mind sharing the other ones.
Now you're showing an example of monthly options.
Yes.
One question is, can you use weekly options?
Yes, and when I was doing the put credit spreads, I was doing weeklies. The one thing, once I started noticing that it's not a bad thing to hold these longer than 7 days. That's why the original paper trades were only 7 days, because I was literally doing next week's weekly, so at least 7 days ahead. I've now found that the monthlies are there's a little more volume on the monthlies, so I'm not having to exclude so many. But you could do weeklies, yeah. There's nothing magic about the monthly except at any time you probably have at least on average 14 days left, and that's frankly why I went to monthlies.
And what was the average gain on the real option trades? I think you showed that as 72%, right?
That's not the gain, that's the percentage that won. This is the gain right here. So the red, let's pick halfway through. In the paper trades, the average gain was whatever that is, 50-something%, and the live trades were just a slightly below that. That's me getting out too soon.
Okay.
So conversely, the average live trade hit 100% if I'd have held it for 13 days. And so what I did, just to be transparent, is if I got out here, I kept tracking it in my spreadsheet later as if I'd held it. So I didn't actually achieve all these gains, and I can put something together we can show later. So I traded, these red ones are real trades, but I typically got out somewhere around 50%, just because that was my stop methodology at the time. And these were in May and some June, so they're fairly recent.
That's all the questions we have, Jim.
Cool.
Unless there's some more coming in.
And I think I'm turning it back to you now then.
Okay.
You want to talk about your special?
Well, once again, you're in charge of the slides.
Yeah.
So, as some of you may know, at times in the past I've offered a free trial. And really I would like to offer a free trial, but I find also that because of the ease with which people can get email addresses these days, a number of people have taken advantage of that. So I ask a nominal price for people to take a trial, or what I now call a test drive. And that nominal price is normally $9.95. And that tends to exclude the tire kickers and only attract people who are seriously interested in what I offer. If you're not currently taking a trial, then I would like you to take advantage of a special offer here, which is that you can sign up for a mere $4.95 for a 30-day trial. Just go to our homepage, click on the test drive button, and you'll be presented with a form which will ask you for your username and password. There's a box there for a referral code. Just enter Squeeze Play in that box, and you'll then get a trial for only $4.95. Next slide, Jim.
Trying. Here we go. There you go.
So if you have any questions, we would be happy to answer them for you. I'd like you to do it through the support forum rather than through emails either directly to myself or to Jim, because that way other people can join in the discussion and see the benefit of the Q&A exchange. So does anybody have any more questions?
Now, can they ask questions about your website tonight?
Sure.
Okay.
Happy to take any questions.
I wish I could see them. I feel left out.
Yeah, I wonder why you can't.
I don't know.
And there seems to be a facility for people to put their hand up.
Yeah.
But I don't see how to do that. This is my first experience running a webinar. Did you record this webinar so we can watch it later? Yes, we did. And I'll put a link on the website to the webinar. Well, I see a few people saying thank you. It was very informative. So if there are no further questions, and it seems that there aren't, I'd just like to thank you all for participating, and as I said, would be happy to answer any questions you have. Jim, any final words from you?
I would just encourage people to kind of jump in and paper trade this if you're interested in options at all. This is proven to be a pretty good way to do it. And, you know, you have the strength of Mike's over 10 years of experience following cup with handles, so that's one of the reasons that I think this thing's working so well. And so what I'd love to do is see us get kind of a group on the support forum to you know, teach each other what's working. There's so much opportunity here. We haven't even got into things like filtering for RS or the probability, or not even to mention the squeeze candidates, which, you know, I'm excited about down the road because there's a lot more of them, which means that we may be able to find even better, you know, once we refine the criteria that works in the options market. So we're just really, I wouldn't even say we scratched the surface yet. So I'm hoping this has been good. I enjoyed it. I'll keep an eye on the support forum if any questions are directed at me, but if you don't get an answer, bug Mike and he'll bug me. I'm not purposely ignoring it. Anyway.
Okay, well, let's wrap it up. Thanks very much, everyone.
Thanks,
Bye.
everybody. Have a good evening or morning, whichever it might be for you.